Amitabh is currently the managing partner with the IAN fund. Okay, the Indian Angel Network has a fund as well, and he is one of the key people who set it up. Prior to becoming an entrepreneur and investor, between 1986 to 2006, he worked with several large companies in senior management positions, including Canbay, Zansa, Infosys, HCL, and so on, handling profit and loss accounts of more than 200 million USD. And for some of these companies, of course, there's a lot of entrepreneurship that happened thanks to his efforts. But following that, Amitabh has picked up several entrepreneurial ventures. The first thing he started off was with Copper Chimney, prominent restaurant in 1991, which was later acquired by Blue Foods. His next venture was Motec Software, which was acquired by the Reliance Group. The third venture was outsourced product development company called InfoSpectrum, which was acquired by Persistent, which is a Pune-based IT company. The fourth one, of course, was CSIR Tech, where he was trying to explore how one can commercialize technology and IP of various publicly funded research institutions around the country. Amitabh has also worked as an entrepreneur in residence with India's first domestic venture fund called Infinity Ventures. And as part of that, he was a mentor for two investee companies, India Games and Brain Visa. Both of these investee companies eventually gave successful exits to Infinity Ventures. He's an active member of the Indian Angel Network for the last 10 years. He has evaluated hundreds of companies. Even now, he's listening in on many companies when they're doing their pitches. And he's of course picked up several winners for the IAN team as well. Currently, as a managing director of the managing partner of IAN Fund, which by the way is related to an Indian Angel Network and relatively unique in that sense. He is looking at a wide variety of different investments. I hope he'll also tell a little bit about ticket sizes there as well while he gets a chance to talk to you guys. Amitabh is actually an engineer by training, did his studies from VJTI, and now of course in his current avatar, he's an investor and an entrepreneur himself. Okay, so welcome Amitabh back to Venture Center. Very happy to have you here. Floor is yours. Yeah,
thank you
please.
So much. Is this on?
Yeah.
Okay, awesome. Hello guys. Just kind of get a general sense of who am I talking to, so that I don't want to talk to each one of you. Just want to know how many of you are doing your startup for the second time?
This one.
Okay.
Changing slides. Okay.
Awesome. And if I can ask any of the second timers, why are you doing this the second time? Are you nuts?
I think that's the default state.
Yeah? Okay, awesome. Okay, great. And how many of you are doing this, not the second timers, the first timers, how many of you are doing this for more than 2 years? Awesome. It's good to hear. That's great. So, thank you for that introduction, Dr. Premnath. Venture Center is very dear to me. I've spent almost 5.5 years here trying to do this commercialization of technologies emanating from government-funded labs in two ways. One, to help them do tech transfer, and the other was to invest in companies which had deep sciences as their background. Didn't work out, but made lots and lots of friends. I counted the other day, must have made connections with about 4,000 scientists all over India, not just in CSIR, but across several different things. So it's been an honor to work with CSIR and also with Dr. Premnath, who was on my board at that time. So I'm very happy to be here. Yeah, so raising money for budding entrepreneurs. Yeah, so the first time I talked about this was more than 10 years ago. And as I look back, some of the things that I did 10 years ago, that I talked to people about 10 years ago, are still valid. Dhanda is dhanda. It doesn't go away at the end of the day. So when you're raising money, I drafted this sentence very carefully. And there was one key word here, explore. Yeah? If you're going to raise money from the right people who think that you are best suited for in terms of adding value to your business. And if you're going to somebody just to only align your business objectives with that of the investor, it's not going to work. So you have to explore whether the people that you're going to raise money from, are they really the right people who will actually help you build the business, and will you really be seen by them? If you're going to a fund which is, say, in social impact, and you're going with a very hardcore commercial, it just doesn't make sense. You got to see where it makes the most sense, right? So that's essentially the reason. This is something that I want to start with, is I believe very honestly that beauty is in the eye of the beholder. How many of you have not heard this before? I guess everybody's heard this before, yeah? If there is no beholder, what happens? I don't know about that. But I'm saying that beauty is in the eye of the beholder. If there is no beholder, it's very difficult to imagine what that beauty would mean. Yeah? So, anyway, I have a story that I want to start with. I was walking on the streets of Champs-Élysées in Paris, maybe 15, 16 years ago. And this was a Sunday morning at 10 o'clock in the morning. And this friend of mine and I were just walking, and there was a lot of festive environment. People were juggling, somebody was breakdancing, somebody was making pottery, painting. So I saw this painter who was sitting on the edge of the street with his leg on the road and his back on the footpath. And he was about to start painting, kind of like this guy, not standing, but sitting down. So he had the palette, the colors, the canvas, everything was ready. He was about to start painting, and I just wanted to make fun of the guy, and I walked up to him and I said, "Sir, when this painting is ready, how much will it cost?" He says, 350,000 euros. I said, "What?" I mean, I said to myself, because I didn't want to insult the guy, I told my friend, "Let's go, buddy. This just doesn't make sense. 350,000 euros, look at the guy, he's sitting on the street." So as I'm dragging my friend away from this painter, my friend pulls me back. He's pulling my hand back, and I say, "Why?" He says, "Did you look at this guy?" I said, "Yes, I looked at him. What's the big deal?" He said, "No, did you really look at the guy?" I said, "Yes, I looked at him. What's the big deal?" He says, "He's wearing white kurta, white pajama, no chappal, dark glasses, white beard." I said, "My God." I ran back and I saw it was M.F. Hussain, and I said, "Sir, whatever you paint, here is 50,000 euros. This is a fake story, okay? Not real. Here is 50,000 euros. Whatever you paint, I'll buy it." So if you are an M.F. Hussain, your painting will get bought. But if you are not, then you got to show something to me before I'll buy that painting. Make sense? And I'm sure that there are many M.F. Hussains here. Yeah? So that's the story. Let's start with a small, everything about angel investing, venture capital is 8 standard, 9 standard, ratios and proportions, mathematics. You don't need to be an MBA to raise money. You don't need to be an MBA to become a VC. You just need to know 8 standard, 9 standard, ratios and proportions, mathematics. That's it. Yeah? So we'll start with a simple example. One of you wants to raise 2.5 crores and has managed to give away 25% equity. Yeah? How many of you do not understand equity? All right, sir. What kind of business do you run?
Biomedical device.
Okay. And why do you not know equity?
Trying to learn it. I've been focusing on the science too much, I guess.
Okay, I'm going to get into another story, but this is going to be a very short one. It's related to my background, which Dr. Premnath talked about. When I started the restaurant called Copper Chimney, I started it because my brother walked up to me and said, "Yaar, you're an engineer, you're all set for life. You'll get a job and everything. I managed to pay my way through the exams to pass and cheated and everything, and I've managed to get a BCom. What do I do?" And he says, "I want to run a restaurant." I said, "What do you know about restaurant?" I asked him. He says, "I've been to every restaurant in Bombay, so I can start a restaurant." Anyway, he was my brother, So I said, okay, let's go raise some money. So we went to Saraswat Bank. Suresh Prabhu was the chairman, and I had to make a presentation to him 2 days from today. Overnight, I became an expert in finance. When you are an entrepreneur, that's what you do. And it's all about 8th standard, 9th standard mathematics. There is nothing great about finance, okay? So I don't want to hear this again. Tomorrow morning, you will be an expert. Okay, so Angel wants to invest 2.5 crores for a 25% stake in the company. So what does it mean in terms of the value of the company? 10 CR, yeah, simple. Now just 1 second before the 2.5 crore hits the bank account, what is the perceived value of the company?
7.5.
So if the company has become 10 crores and somebody has put in 2.5 crores, after putting the 2.5 crores, if it is 10 crores, then before putting the 2.5 crores? 7.5. Yeah? Right? That's called the pre-money valuation. Is this clear? Okay, I'm going very slow right now because I'm trying to gauge the level at which you guys are right now. Okay? So basically it means that you have a pre-money worth of 7.5 crores. Yeah? Just 1 second before the money hit the account. Now, you're about to make a presentation to an investor. Yeah? What do you think your presentation should contain? If I can ask the gentleman at the back. Yes, sir, with the glasses. Yes. What do you think you should be your presentation? You are worth 7.5 crores pre-money. So what should your pitch be? What is your pitch?
Maybe it's the valuation of the company.
Yeah, yes, I know. But so you are about to now start making a presentation, half an hour presentation, which you talked about. Yeah? What should you talk about? Why? 7.5 crores. Any other views on this? Sir?
How the company is going to be so from 7.5 crores to 75 crores or even more.
Yeah, yeah. So your pitch obviously will contain that part and the future as well. Yes, sir.
Yeah, I was about to mention that future part.
Yeah. So you'll talk about how my company is worth 7.5 crores. Yeah. And in trying to show that my company is worth 7.5 crores,
How is it 5x, 10x better than the consolidation?
well, so you know, you will have all that story in your presentation. Maybe it's a 15-slide presentation that you're about to show just to get to the next point of being called for the diligence, right? Just before you're called for the diligence, I think, did Shrikant talk about that? Yeah. Okay, awesome. So just about before that, you're going to have to talk about how your company is worth 7.5 crores. Now, you will have certain assets in your company, maybe a laptop, maybe some machinery, some diagnostic tool, some people, etc. Yeah, all those are tangible. And then there are some intangibles that you're going to talk about, which is the future of the company and the market and how many orders that you have in your hand and so on and so forth, right? So there's a tangible part of the story which can be touched and felt, like your balance sheet, your financials, your assets in the company, and you'll have an intangible part of the story. I think, is it too bright?
Yeah.
Is there a way to?
I think let's go with it. Because
Okay,
it's going
okay, fine. So you'll have a tangible story plus the intangible story, and that must, in the eyes of the beholder, be perceived to be 7.5 crores. Yeah. If you just say that my mom thinks that I'm great, isn't going to cut it. When you talk about the letters of intent that you have in your hand, the orders that you booked, or the traction that you have, the numbers of people who are coming to you for inquiries for your business, whatever those product might be. How many of you are in internet business? What kind of a business is that, sir?
It's an online productivity tool.
Okay, awesome. Any other, what kind of business is yours, sir?
I'm biotech.
Yeah.
And biotech, but it's an R&D-based biotech solution.
Okay.
Developing.
You're developing a solution.
Yes.
Okay, and that will have an intellectual property of some kind.
Yes.
Okay, awesome. You, sir? Yeah.
We are into therapeutic foods
Okay.
for diabetes.
Okay, nice. You, ma'am?
We are making diagnostic kits which will also have an intelligence.
Okay. Anybody else wants to just raise their? I just want to get a sense. Yes, sir.
Continuous analytics as service.
Continuous.
Analytics as service.
Okay. Yeah, ma'am.
We're in the clean air space,
Yeah.
trying to prevent infections and product contamination.
Okay. Is it like a physical product? Yeah.
We're into medical device. We're developing AI-based eye screening robotic device.
Yeah. Yeah. Yes, sir.
Banana fiber shirts.
Banana fiber?
Shirts.
Ah, nice.
We have presented for our Prime Minister.
Oh, okay, okay. Now I do remember that. Awesome, awesome. So whatever your story is, you'll have to put together something which convinces the investor that this team is going to, make me lots of money. Yeah, and it's very difficult to do all this discounted cash flow or a startup company for an early stage company because you don't have revenue traction. Most of you are at the development stage, prototype stage, so it's very, very difficult to do. I've learned what DCF is, but I don't practice it. It just doesn't make sense. It's only at a later stage company when you're raising your Series B or Series C that it matters at all. Anyway, so that's your story. Okay, let's talk about popular sources of funding. So you can put your hands in your pocket, pull out all the money and say, I'm going to fund this business myself. Yeah? I can go up to my mama, kaka, chacha, neighbor, nani, whoever, and say, or fools, and raise money from them. Yeah? I can also go to ICICI Bank, go to SBI Bank, whatever is out there. I can also go to Muthoot Finance. Yeah? Any of those companies from there. I can go to BIRAC, I can go to DBT, DST. Yes, yeah, you have a question?
No.
Okay, that's okay. What I wouldn't do is to go to a loan shark. Yeah, they have a funny way of recovering money. What I would do in your case is where I'm assuming that you've already funded a little bit from your pocket. I'm assuming that you've already gone to your mama, kaka, chacha and taken some money. Yeah. And now you're about to reach this stage. Yeah? So you can go to an HNI. There are these prolific investor HNIs. Shrikant is one of them. And there are many more. Rajan Anandan is out there. There's, the Bansal brothers. Many of them are there who are very prolific investors. They operate through family office. So you go and approach the family office and then you make your pitch. How many of you do not know where to go and raise your money from? One time I was hiring this secretary for myself. I had never hired a secretary for myself. I was always given a secretary. So whichever organization I worked for, this is the secretary that you've inherited. But this one time I had to hire somebody and I didn't know what to ask this person. I really didn't know. So I posed a question to her and I said, I knew of a colleague of mine called Gordon Mosino. He worked with me in Chicago. He used to work for KPMG. That was about 12 or 13 years ago. I think he has left KPMG and he's probably joined Philips. Can you find me this person's phone number? She came back with 6 options. I did not check them. I hired her simply because she took the effort to go out and get the number. Yeah? So you will know who to go and raise your money from. If you have a phone number, you have an email ID, you can go and find them. I don't know if any of these people managed to get the copy of the 3-page, maybe somebody can. It's been sent. Okay, so do have a look at that. There are several ways to find your investors. If you did, there are 25 significant VCs in India. There are probably 150 registered VCs in India, but not necessarily very active or not having significant amount of monies to invest. But you can find the list of all of those. Go to the IVCA, the Indian Venture Capital Association website. You'll get a list of all the investors. You can find, if you just did a Google on any of this, you'll be able to find. So today, in today's world, there is really no excuse for saying that I can't find an investor. There's plenty of ways, and if you don't, just approach me. I will never fund you, but if you tell me. Okay, so do you understand who the strategic investor is? Or do you not understand who a strategic investor is? If I'm a food tech business, and if, what's the name, Jubilant Foods wants to put some money into my company, that's a strategic investor. Yeah? If I'm in the property business, and if Shobha Developers or Rahejas or Mantri wants to put money in my, that's a strategic investor. So that's essentially who generally strategic investors are not very well looked upon by co-investors such as us, because we also want to get an exit. Do you know how does a fund work? A venture fund. How does it work? You must know, because you're going to raise money from them. Yeah, you're going to win, so you have to make sure that the venture capital company also wins. Yeah, so you must know how they work. We also pool money from others, go and get our fund registered with SEBI, and then essentially give money to you. And 9 out of 10 are going to fail. By statistically, throughout the world, in any business, across all 9 out of 10 are going to fail. How am I going to make money? So one will be the one which will give me 1,000 times returns, hopefully. Yeah? And by the way, 90% of the VCs in the world don't even return the capital that they have taken from their investors. 5%, between 5 to 10% return the capital. Less than 5% make more than the capital. So what kind of people invest in these VC funds?
Hedge funds.
Sorry?
Hedge funds.
Hedge funds, yeah.
Pension funds.
Pension funds, yeah. HNIs put in a lot of money. Yeah, so for, yeah, absolutely. So many of these people, for them losing 0.5% of their net worth just is not a big deal. But that 0.5% could actually turn out to be a significant portion if it returns a big thing. Yeah, so that's how the investors work. Okay. Yes, sir. Yes, ma'am. You can stop. No. You can stop me at any point and ask me any question.
Can we finish the conversation on the strategic investor
Yes.
part? Because there are a lot of people doing tech-based businesses.
Yes.
Strategic investors seem like a very, very attractive option.
Okay. No. So good question. So how many of you have heard of a product called Finacle? It's a banking management software. Yeah. Created 25 years ago by Infosys, and it was created for ICICI Bank. Yeah, and then they took it to other customers. Yeah. Fortunately, they did not have just ICICI Bank as the customer. Yeah. They made sure that it was neutral, because then other banks will also use that software. Otherwise, nobody will use a banking software which has been developed only for ICICI. Yeah. So coming back to your point, if you take money from a strategic investor whose competition will then stop using your product, is it worth? Now you get the point? So you want to go to a strategic investor at a stage when other investors have already made money and now you are ready for being bought out. Make sense? Yes. So you agree with me, blue shirt? Yeah? Yeah. So I mean, you can go to a strategic investor, but don't give too much equity. Then make sure that that strategic investor's competition also puts money into your company. You understand? All right. Of course, you can go to VCs, private equity funds if you are very, very late stage company. So by the way, all this is private equity. All this is private equity. Private equity means not listed company. Investing money into not listed companies. Yeah, that's essentially what private equity is. Now there's jargon, angel stage funding, there's VC stage, there's private equity stage, and so on and so forth. So you have different stages of funding, but they are all essentially in the broad category of private equity. Okay, so the section I'm about to talk about is very important. So what makes a business investable through equity? Because you can have your business invested in through grants, through debt, and through equity. So let's look at what makes a business attractive for equity investment. What I'll do is I'll start with what's not attractive for a, yeah, and then I eventually come to that. But the point is pretty much the same. Okay, I'm sorry that the slide is not very, very clear. I'm going to read it aloud. The first one says business requiring working capital only. If I am in the recruitment business, for example, Yeah, I go to an organization, get requirements for who they want to hire, come back to my table, go through LinkedIn, go through various job portals, find the right candidates, do initial screening, and then present my candidates to the company that wants to hire them. And the company says, okay, I like this particular person. You will get your commission, which is 8%, 12%, whatever that number might be, of the annual salary at the end of the third month. Yeah. So essentially, for doing very little effort, I will get paid in 3 months' time that cash. Now, this is a cash business, because in 3 months, all I have to do is pay the salaries of my employees and the rent for the office. If I get that money, just that much, 3 months working capital, then I will start to make huge load of money. Usually the margins for a recruitment business is close to 60 to 70%. So such businesses, they don't require venture funding. They just require debt, a short-term debt, maybe a line of credit. Yeah, so you need to see whether your business really requires debt or it requires equity. Yeah, and at what stage you require debt and at what stage you require equity. Yeah. So if a business requires only working capital, then it's less investable through equity. If a business is requires you to make huge amount of capital expenditure. How many of you do not understand capital expenditure? If you don't understand capital, I'm not going to, make fun of you or anything. All right, sir. So capital expenditure is anything which you make to buy a equipment or a plant and machinery, those kinds of things. They are essentially capex. Yeah. So for an early stage business, which is, let's say, raising 2.5 crores, and if you tell the investor 2 crores out of that is going to go towards buying one machinery, that just doesn't make sense. Why can't you rent that machine? Why can't you rent that space? Why can't you rent that factory? Why can't you rent that analyzer, spectrometer, or whatever? You can come to Venture Center and use that. Why do you want to buy that? So it doesn't make sense if your business requires huge amount of capital expenditure, yeah, out of the total money that you're trying to raise. Venture funds generally don't like a business which is run by a single founder. How many of you are a single founder? Okay.
Sorry, excuse me.
Yeah.
So capex, you told our innovation itself contained lot of capex. The innovation itself wanted new machineries. That is our innovation.
You can rent it. Oh, sorry. You're going to?
Innovation itself is a new technology that required capital.
Yeah. So that is to make the design of the thing, which you will outsource the work to somebody to, say, make in China, make anywhere, somewhere else, right?
For that, we need that accessories that cost itself very high.
Okay. So accessory is not the same as capital expenditure. Consumables are not considered to be capex. Yeah. Somebody else had a question. Yeah, you are a single founder company. Okay. What kind of a business are you in?
It's just online business intelligence productivity tool.
Okay. How dependent is your business on you?
Very much.
So you see the risk for an investor. If this person has a flu, then my investment is stagnant for that period of time. Yeah. So you want to make sure that you go and get a partner with you at the earliest you can. How many of you do not have a private limited company? Okay, so you are at an ideation stage right now? So you have not formed a private limited company yet? No. Not registered with ROC? No. Okay, yes? Yes?
So I have a slightly different question.
Yes.
I run a drug development company. I am developing a new class of antibacterials. So I am the only scientist, and I have an angel investor, and he has been investing for quite some time. But now I am looking to raise more money from VCs or stuff to test the molecules around. So is it a good team? Because there's one scientist.
Yeah. So everybody got the point. His issue. Think from beauty is in the eye of the. Yeah. If I am the beholder, what will I see? I will look at the technology that you developed. Yeah. I will look at the market. Yeah, I will look at the team.
Yeah.
Yeah, and if you say that the team comprises of me who's full time
Yeah.
and my partner who's part time,
Yeah.
yeah, then it's not something that attracts a VC.
So which are the other people I should have in my team? Should I have scientists? Should I have finance people? Should I have people with legal knowledge? How should the team be structured?
At your stage, because you are in the drug discovery stage, you don't really need a finance person right now. Okay, you can outsource that function to somebody. It's not critical, but you will need that person once you've raised money and you raise significant amount of money. Then you will need a good finance person, not accounts, finance. Yeah. You understand the difference between accounts and finance? I'm assuming. If you don't, please raise your hand. Okay, so you will need to do that at some stage. I have seen many drug discovery companies where there are two founders, yeah, one holding a large sum of equity, the other holding small sum of equity. Yeah, but you need to have some kind of a risk mitigation done to raise institutional money. You can raise money from an HNI. Yeah, but raising money from an institution, the institution is answerable to its investors. And remember, 9 out of 10 companies are going to fail. Not because they are not good. Market conditions can change. Anything can change, right? So I need to make sure that I interact with somebody who has a team. So if I have to choose one team which has a single founder versus another team which has 3 people, 2.5 people, yeah, from the risk mitigation perspective, the 2.5 sounds better.
So another one person, another scientist will be good enough.
Yeah, of course. Yeah, but then you must know everything about running a business overnight. Overnight. What's the big deal? It's mathematics. And 8, 9 standard mathematics. It's not a big deal. We just have this. Who are the best salespeople? The technical people are the best salespeople. They're not the great marketing guys, but they are the best salespeople. In my opinion, who knows the product better than the technical guy? Sales is not done over a glass of beer. Yeah, it's hardcore number. Somebody's going to shell out money against that one. So they want to talk to the real guy. Yes, sir.
So are you equating the finance person with the person who knows how to run the business?
No. Finance person from a venture capital perspective is to plan the growth of the company and how much money will it. So CEO says, this is my vision along with my co-founders. The finance person says, okay, for this vision to be accomplished, this is the kind of money you should raise. Out of this money, this should come from debt, this should come from equity, and this is how we will account for all the inflows. In case the inflows don't come as expected, we will cut this loss by not have this expenditure. So that's the job of a finance person. Yes, sir.
So coming back to your point about the capex heavy businesses, right? You gave the example of someone who's raising 2.5 crores, 2 crores is going towards buying a piece of equipment. But would an approach where your capital expenditures are taken care of by debt and you use the equity purely for operating expenses, would that
So you should, okay. So first of all, I will not buy a heavy piece of equipment using debt, because that is an asset. If 2.5 crores, may say if you got 2 crores locked up, that's 80% of your money is locked up in one particular asset, that's a bad business to invest in the first place. But let's say you're going to invest 50 lakhs. Yeah, then you don't want to raise debt unless your business is a cash business like the recruitment business. Yeah, where I go and buy an account from Naukri. I make a huge investment in Naukri. I buy an account with 20 users, spending some, 25 lakhs a year kind of a way. That's a huge, that is still operating expenditure, is not counted as a capex. Yeah.
Question regarding the founders.
Yeah.
So I would like to know in the Indian ecosystem as such. So how is it looked upon? It's like, as you asked, one of the questions was previous experience, or the team itself, or the expertise they have. So all of that counts. So is it also 2 questions? One is the number,
I will talk about this. The next slide will talk about this. And if I don't, please pull me up. Okay, I'm just gonna, you can stop me at any point in time because you're asking all the questions which I already have over here. So in some ways, I'm sort of answering those. So not a great thing to invest. Sometimes, you know, many husband-wife teams are great, okay? But when they forget to leave their fights at home and come into the office, it's a problem. So we want to just make sure that, you know, they're mature enough to handle this one. And by the way, although I said the thing about the single founder, Mark Zuckerberg pretty much was a single founder. So there are examples of many people who have done that. Oh, by the way, I have a huge list of companies in which I missed investing, and they went on to do phenomenally well. I have a big list of companies, and I have not come across a single VC who has not got a huge list of missed opportunities, where they thought this business is never going to make any money. And in hindsight, they say, oh shit, I wish I had invested. Okay? So there's nobody who's a guru end to end in the venture business. Yeah? All right. So I don't like single founder family businesses. And if the promoter shareholding is very, very low, it's a problem. Why is a promoter having a low equity a problem? Sorry? No skin in the game. Yeah. What else?
Control.
Sorry?
Low control in the game.
Low control in the game. Yeah. Sorry?
His interest is not there.
Interest could be, yeah. But however, if you look at a company like Infosys, before Narayan Murthy retired, his holding was, say, 2.5%. So why is that a problem?
But that was after the whole
Correct.
series of-
After series of investments, when you get diluted down to that number, it's okay. But at an angel stage, you know, there was this fantastic scientist who came, and I met him in Goa. I was there for some talk, and a very, very good guy. He made a pitch session to me. I just loved the product that he had made. And he was so dedicated, and he was very smart. He understood finance, by the way. Yeah, everything. But then I asked him to tell me his capitalization table, which basically means that who holds how much equity. I found that one real estate guy was owning 80% of his company. What is a real estate guy doing on the cap table in a hardcore scientist company?
He got money.
He got money from.
He got money, but then he's stuck. He cannot raise the fund any further at all, not from institutions.
So this is actually a pretty common problem for a
Yes.
lot of people doing this kind of business. You need a lot of money very early on. And it doesn't also help that you get started with BIRAC because BIRAC gives you the money.
Okay, we'll talk about this. I have I had an Excel spreadsheet that I'm going to talk you through to actually explain to you the issues associated with raising money too early or too late, and raising money at a valuation which basically means that you will dilute very, very fast. Yeah.
So what do you mean by institute funds?
Institution is, an HNI is an individual, and institution is like the Sequoia, the Axel, they are all institutions. Or ICICI Bank is an institution. Any organization that is registered to lend money or to invest, they are institutions.
This would be fund of funds from governments also.
So fund of funds invest into the fund. You never take money from fund of funds. You take money from the fund in which the fund of funds has invested. Yes, sir.
How low is very low?
So it depends on the stage of the company. If it is an early stage, anything less than 80% is bad. If it is very early stage, yeah. If it is at an angel stage, anything less than 60-65% is bad.
But that could be the promoter group.
Promoter group, plus ESOP.
Okay.
Sorry, if you include the ESOP in it, it's fine. It's fine. Yeah, and then when you go to Series A, typically don't go below 50% till you have reached the Series B, ideally. Yeah, we'll talk through an example, and then, you know, it depends on the industry, by the way. So what I have said is a general rule, but I will look at the business and look at the founder, look at the market, and then decide what makes sense. Moving on. Right. What does it say? Misalignment of valuation expectations. So you have a certain expectation, I have a certain expectation, and our things are not aligned. Yeah. So it's not great. And you come back to me and you say, look, you know what, I am involved with creating a drug which will essentially kill the stem cells which promote cancer. So if an organ has got cancers and I have created a drug which essentially will kill the stem cell, yeah. So I'll kill it at the great end, and the person says that I'm asking for 10 crores and I will give you 5% equity in my company. How is that going to work? 9 out of 10 companies are going to fail, irrespective of the technology. How is my mind going to work? I'll have to think about this, whether this is something which is aligned with me. I will look at the stage of the company. Are you raising this 10 crore when you just have an idea? Oh, by the way, I have a thing about idea. If any of you have an idea about a business, write a book. Get it published, I will buy that book. But I will not invest in it, in that business. You got to show me something. Remember the canvas I talked about? Show me something, unless you are an MF Hussain. By the way, there are examples of MF Hussain also letting down investors. Does anyone remember Hotmail? Yeah, the guy made $300 million. Don't have to name the guy, you know him. After that, he started many other companies, didn't work out. Yeah, so it's not necessary, by the way, but you just increase the chances. You're just sort of thinking, or at least when you get sued by your investors for misappropriating the money, you will say, wait a minute, I invested in a money which was by a founder who started Hotmail. What did I do wrong? Yeah, nobody gets fired for hiring an IBM machine, right? Remember, those are the days. Anyway, so unsustainable unit economics. If you are creating a business which is not profitable, it's okay. At an early stage, it's fine that you're not profitable at the business level. When I create the balance sheet of the company and it shows that you have a big loss coming, that's fine. It's not a big deal. But at the gross profit level, gross profit is the sales minus the cost of goods, right? At that level, if you are not making money, then I have a problem. Below that line, below the cost of goods sold, marketing cost is high, everything else is high, I can live with that. But I can't live with the fact that the unit economics level, at the fundamental level, if you're not making money. There was a company in which I invested, I can't name that company. By the way, it gave me 22x in 33 months, flat. But the next guys who came in, they all lost money. Okay, because in my opinion, they took their eyes off of unit economics. The cost of customer acquisition for them was much higher than the sales price at which they were selling the product. Okay, me and my other co-lead investor, we made sure that till the time we were on the board of the company, that we never took the eyes off the unit economics. At the very basic level, that is sales minus cost of goods sold. That needs to be profitable, or should very soon in the near future be seen as becoming profitable. Yes, sir.
So when you mention all of these factors, you would also be looking at those in the documents when the company presents to you.
I will talk about that. Yes.
So when, if you could also at that time elaborate on which sources would you consider credible, from where the founders can bring their.
Remind me if I don't pick up this topic, but I think I'm going to cover that. Remind me if I don't. Yeah. Yes.
The issue is calculating COGS is little tricky. So because there are a lot of factors, the numbers are not that much proportional. So how to calculate COGS at that time?
I think it's a very, very good point. So first of all, I as an investor need to know why you are saying that you don't know this. You see where I'm going with this argument? I need to know why you don't know this. Is it because you have not done homework?
The assumptions are not correct.
Yeah? Okay. So there are 5 things that I look at an overall level to answer your question right away. Let me just take you to that. Yeah. So I will look at the team, the dynamics of the people in that team. I will look at the market size. Is there headroom for growth? Is the market large enough? Yeah? So I want to see whether there's headroom for growth, because only then I will get an exit. So if I am going after an industry whose size is say 100 crores and this particular person is going to be forming 10 crores, 10% of that market, that's great, but 100 crores is the limit. So I want to be in a market which is 1 lakh crore, right? So that's the reason why I will look at market, and I will talk to you about the sources of where I get this information. I will talk about that. Yeah, I will definitely look at the product, but my first consideration is team and the market. These two at an early stage, these two are very, very important. Yeah, the homework that I do on my competition, the homework that I do on my customers, my suppliers, the entire market, the entire ecosystem, and I must know who they are. Yeah? Then I will look at the product. I will look at my opportunities for returns. I'll assign certain probabilities. By the way, I'm a partner in a fund. A fund has a partner, below that is a principal, below that is an associate, below that is an analyst. Okay, there are only 4 levels in most venture funds. So I as a partner, and the principal is like a partner in waiting. Principal is a person who is just about to become a partner, but has got lots of years of experience as an associate. Yeah, my partner and the principals, we need to work with our associates and with our analysts. Yeah. Now, if I turn down each and every suggestion from them, I'm not going to get their cooperation. Why did I hire them in the first place? I should have fired them. Yeah. So the dynamics between the partner and the associate is also something that you need to be aware of. Yeah. All this impacts. So so what happens is that I as a partner will fall in love with the entrepreneur. What an entrepreneur! What a team! What a market! It's the job of the analyst to come back and say, wait a minute, sir. There's more to it. How are you going to get your returns? Here's where I see a problem, and they will present the problem to me. Okay? So I will look at that, and obviously I want to look at what are the terms of investment. One is money. The other is the amount of equity. The third is what rights as an investor do I get. You need to become very, very aware. Please, these are very, very important things. Okay? So what rights will I get in the company? Will I be able to control this company? Not the day-to-day running, but at the overall milestone level. Yeah, can this person just go out and make a 75 lakh investment without my knowledge? Yeah, so I need to have certain rights, controls on the company, which are agreed. And by the way, there is no investor who does not have the best in mind for the entrepreneur. It is just not possible. It's like marriage. It is a marriage. You can't have an unhappy spouse. Yes, sir.
Do you reason out why you are not getting married, or you refusing the proposal to the client so that he can make it a good?
You got to ask me this question again, because this is my favorite topic. Huh? Please ask me this question again. Have you understood his question? What's the question, you man?
Why do you get rejected?
Do you give the reason?
Yeah. So okay. So basically, I think we give feedback. Yeah. Our general answers are watered down versions. This is not in the area of our interest at the moment, right? Our exposure to this industry is extremely high, so we'll pass this at the moment. You know, there are lots and lots of reasons we'll give. But what I do is, I will spend, if the person has already risen through the rejection, so I have a rejection sort of a waterfall, yeah. At a very basic level, there's a team of around 6 or 8 people who look at and they say, okay, at that level, 9 out of 10 are basically junk. Somebody's just written one page and said, sir, this is my business plan. One page and there is nothing in it. It's all motherhood statements. So when you look at that, you know this is not the business that you want to take forward. Yeah. Then it goes to a internal pitch session of my analysts and my, so whoever has sourced the deal, then my pitch session, they will go through an internal pitch session. Out of that, when they get shortlisted, then they bring the deal to me. At that stage, you know that these people are pretty much qualified. Yeah. So if I am looking at 12,000 deals a year, which is the case with Indian Angel Network, by the way, you get a huge amount of, out of that 3,000 make it to the internal pitch session, and out of the 3,000, 300 come up to me. And out of the 300, 30 will be invested into. Okay. So you see the ratios and all that. So when you come to that 30 level, and when I have to, 300 level, I don't mind spending some time with the person. But it also depends on the other entrepreneur, how his or her responses are to me. If they are not getting the hint, then at some point I'll have to say, look, I'm late for my next meeting. Can we do this some other time? And that time will never come again. Yeah. So I have to be very subtle in my, but that relationship is important, because I can't just let the entrepreneur just go away without knowing what I think is wrong. So it's an important responsibility that I have. And by the way, I have invested time. Yes, sir.
Sure. You mentioned that team and market are the most important things.
At the initial stage, yes.
So again, at the angel investing, when you talk about products,
yeah,
you mentioned like the painting example.
Yeah.
It should be there, but how much is it like completely perfect product market fit, as you call it?
We'll talk about that. We'll talk about that in the next slide. Yeah. Yes, sir.
What kind of cases do you face when entrepreneurs don't basically accept the VC investment? There might be the way VCs do not like particular things in the discussion. Entrepreneurs also might reject a fund.
Yeah, that happens.
So what?
Actually, I want to invest in a business where I have to chase the entrepreneur. Ideally, I would like to, it's like the dating game, right? It's kind of like that. If you acting hard to get, and overall beauty is in the eye of the beholder, and this is the kind of person that you definitely want to date, then you want to go after that. It's no different. Yeah. So ideally that happens. So you want to create, not by fooling the investor, definitely, because you cannot fool the team of investors. Maybe you can fool one person in that investment team, but not the entire team. It will be very difficult. So if you're putting together your arguments correctly, if you are going to an investor with a term sheet on hand, what's a term sheet? The initial document that a venture capital fund signs to say, I'm interested seriously, and if I do go ahead, then these are the terms at which I will invest in your company. So that's called a term sheet. So when you got a term sheet, that means somebody has already diligenced that company. So many a times companies come to me to say, sir, I'm raising 12 crores. For 6 crores, I already have a term sheet. Somebody has already set the valuation. I will say, who's set the valuation? They will give me the name of the investor, many of them, and then I'll say, okay, these are the guys, I trust them, I'll trust their valuation, we'll just go ahead. We'll fast track that. But I've had situations in which the guy, my analyst who's chasing this person to get his appointment, sir, can we please invest money into your company? And the guy finally said, no, I think I will not take money from you, not because I don't like you or anything that your fund is not good enough, but you are too small a fund for me to for you to participate in my next round. You raise series of money, right, before your company make it $1 billion company. Flipkart raised what, $4 or $5 billion, and in my opinion, Flipkart it was not a capital efficient company. It raised $4 or $6 billion, I forget how much amount of money they've raised, and they got sold for 20. It's not a great return. And over whatever, 12, 15 years. You look at Google, there are very few Google companies out there. Totally it raised 25 million, and its market cap is 125 billion. That's capital efficiency. Capital, that money that you've raised and what value you created. And since beauty is in the eye of the beholder, I will keep coming back to this sentence. Seriously, guys, internalize this one. Only when you get valued by somebody else that it's value. There is no intrinsic value in a company. If there's no beholder, I don't know what to do with beauty. Yes, sir.
Some investors.
Yeah.
Some investors saying that please take this money first so that you will get valued in future like this.
That's a trap.
They are giving 20 lakhs and they are demanding 4.
Yeah, we'll talk about that. That's get there in my example. Okay, capex heavy services only. If you're just creating a BPO, I mean, you really don't need my money. BPO businesses, you know, they can be just invested through debt. You just take, you know, funding for 6 months, and essentially you'll get back your money back. From the time you deliver the service, you'll get, why do you want to raise, why do you want to dilute your equity? Equity is the most valuable asset in your company. Write this down in your mind. Equity is the most valuable asset in your company. Do not give away equity as far as possible. Take only debt if you can. But obviously you should be able to service the debt, that is return back. Yeah. Incongruent products or assets in the company. I'll talk about that. Limited exit option for the investor. So as an investor, I'm responsible to my investors, right? So, you know, I got to give money back to them. So for me to give money back to them, you have to give money. You have to get me my returns. Even if you run the company forever and never exit, please come.
Is there any this thing that unlimited exit option? Then why people have to go for asking for money from the VC?
Yeah, so I'll give you the money. Okay, so if I give you, when you go to a bank and you take a loan, there's a term for that loan, right? And there's a fixed amount of money that you have to return to them. And against that, what will they do? They will take collateral. They'll take jewelry, they'll take your house on mortgage, and so on and so forth. But when I, as an investor, put money and take equity, what do I get? A piece of paper which says you hold so many shares in this company. In the event I, you know, throw away your money in the gutter, this piece of paper is worth nothing. So why should I put money in your company? Yeah, that's the point. So because I am investing money in your company because you have given me the confidence at the time of the diligence that you are the right person to get me at least 1x return. If nothing, you will return back my capital. When I get that confidence, that's when I will invest. I will do all this diligence. I will do discounted cash flow. I will do all of that. But at the end of the day, I'll think from here, but take the call for the final signature from here. Is this the right team that's going to get me an exit? Let me move on. Okay, incongruent product basically means that if I have a company in which I make comb and I also make fax machine, they are incongruent. Who will buy this company? Okay, that's what I mean by, I give an extreme example. You need to think, if you are in, let's say, you know, a suite of drug discovery, and then you suddenly find that, hey, wait a minute, as a offline of this, I can also do some CRO. Yeah, some contract research. Now think from, CRO is a great business because it gives you cash. It's like services business, right? But that services business may not be interesting to the company which is going to acquire your company. So think what kind of assets you are building into your company. They need to be aligned from the point of view of the eventual acquirer. Yeah, so you need to align your assets. So that's what is less investable. Let's look at what's investable. Any business with defendable IP. Don't tell me I have a patent, sir. I don't have to violate your patent in order to achieve the same objective. right? So please give me freedom to operate. I must get the feeling that there is actually freedom to operate in a particular geography for that defendable IP that you've given me. How well is the construction of the sentences in the IP against which you got the patent? Yeah, so I need to see that. Promoters, I need to know everything about you. Do you have a dog? Who's your neighbor? If you've had any illicit affairs, I want to know everything about you. Risk mitigated team. So I need to have a team where people play off of each other. How's the dynamics between the two? Are they going to end up fighting with each other? I've seen many organizations in which the founders fight with each other, and that becomes very, 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 very bad. So if you're too close a friend with somebody, please don't get into avoid if you can, unless you worked out, you're mature enough to work that out. Yeah, and then give me the comfort that yes, you have worked it out in yourself. If you say that, skin in the game. If you say that, sir, as soon as I get the funding, I will quit my job and I'll start this business, then you are not an entrepreneur. Let me give you an example of an entrepreneur. Okay, so two guys meet. One of them entrepreneur, the other a successful business executive. Both of them are standing at the edge of a cliff. It's 200 feet above the ground, and below there's a stream of water which is flowing. And they've both been told that somewhere in that stream there's a deep enough place for you to dive into. Yeah, one guy is a hardcore entrepreneur, die hard, and the other guy is a successful executive. So I'm obviously exaggerating here. So the successful executive climbs down the mountain, walks along the river and says, hey, there's deep water, do book. He says, the entrepreneur says, I think it's there. And he jumps. Halfway through he discovers, oh no, oh shit, it's not there, it's here. Removes his shirt and uses it like a parachute and says, there. 9 out of 10, he dies. Okay? So if you want to be an entrepreneur, think about it. That was to make your point. All right, so skin in the game. Many VCs would like to see, or angel in stage would like to see whether you are mentorable. If you've already decided in your mind is fixed, then generally, there's nothing more to learn for you, then why have you come to me? Maybe you can go to somebody else. Okay? Obviously, we talked about this. Unless there's headroom for growth, I will not get my exit. And we'll talk about how this is impacted as you do your cap table planning for future. So you have a certain cap table today, and then you're planning for future because you want to raise money. So you need to have headroom for growth. This is important. Business indicators of value is clear. What is the value in your company, sir? Would you like to talk about what's the value in your company? I don't know what your business is.
Okay.
Where is the value in your company?
The technology platform.
Okay. So the technology platform has been developed by you and your team members. Yeah? And you've clearly created the best product that there is. And nobody else can create that. Are you sure? I am the investor. I come across 12,000 deals a year. I have seen a deal like yours. Yeah. So I don't know. Maybe technology is the value in the company. Yeah. So once you've defined that, whatever the value in your company is, maybe the value in your company, for example, who was in the internet business? Yeah, okay. So maybe the value in your company is the amount of active users that you get on a monthly basis. Yeah, and why that is important? Not so much to the partner. Remember, I talked about the organization structure of a LP, of a VC. Not so much to the partner, but to the analyst and to other people. They will look at, okay, what was a company similar to yours, how much did they get valued for so many monthly active users? So if that company got valued at 12 crores pre-money when there were 2.5 million active users, then the person will say, okay, 12 crores divided by 2.5 million active, that's the multiple. That's the kind of valuation that I'll apply to you. This is what the analysts and the associates will do. Then they will bring it up to me, and it's me to decide, no, this is not applicable, or it is applicable. It's for me to decide. Yeah. So on that basis, you must know for your business what is that value, and what's the key indicator of that value in comparison to a company in your industry. Because at this early stage, it is very difficult to do any DCF to arrive at a value of your company. And by the way, I was telling you about valuing somebody too low. So as an investor, if I, let's say, put in 2.5 crores and take 40% of your company, I would rather not invest than to take 40% in your company at this early stage. It just doesn't make sense.
So who does the valuations? Like for a new drug molecule, which might be worth 200 million, 300 million, or maybe worth nothing at all?
We will take this question because this is a really tough one. So first of all, there are not enough mature investors in India, who can do that. Mainly because in the ultimate acquisition or the returns or the exit for the investor will more than likely come from an entity outside of India.
That is true.
Okay. So in which case I need to make sure that I have people in the market where there's a possible exit. So I study the exit definitely before I make any investment. So I'll have to make that comparison with another company, and then first of all, I will evaluate. We talked about the team, the market size. Yeah, those two are very, very important at the early stage. But then I will also look at study the exit opportunities for me, or at least the returns. Yeah, for me. So I'll need to do that. We have made certain investments in spaces which are similar to drug discovery. Yeah.
So I have another question. So we have built a platform technology.
Is it a specific question which others can relate to? Let's do that during lunchtime.
Well, yeah, I also have one-to-one with you sometime tomorrow.
Yeah, of course, we'll do that. Awesome. Okay, so somebody talked about product market fit. Yeah, so for me, it's very, very simple. If X percentage of your customers are going to be very badly impacted if you shut down, then you have a product market fit. So if LinkedIn shuts down today, which it will not, many of the recruitment companies will say, oh my God, what the hell am I going to do now? Okay, that's a clear example of a product market fit. It might be different in your industries, which when we talk one-on-one, then obviously we'll talk about what that might be. We talked about the tangible part of the story, intangible part of the story. This forms the part of the tangible story, the pitch that you make. Yeah. We talked about incoherent assets. Opposite of that is the coherency of assets that you're trying to create. Again, beauty is in the eye of the beholder. You want to make sure that they are all aligned towards a single buyer. Yeah. So I had invested many years ago in a company, quite accidentally. I just gave some loan to a very dear friend of mine, and when the time came for returning, he came to me and he says, here's the check. And I said, how's your company doing? When I heard him, I liked the thing, and I said, hey, wait a minute. I'd like to convert this into equity. I like your business. Yeah. So this guy was in outsource product development company. Okay. So they would do product development for others, for their customers. So they wouldn't do bespoke application development like Infosys or any of those guys do. I liked their business. The average length of the contracts that they held was around 3.5 years. And for an early stage company, that was great. And I looked at the marquee clients and I said, look, there's a brand that is getting created. Yeah, so you built something, but there was a problem. This company also, so they had large chunk of their business was essentially the contracts which they held, but they also owned a building. They owned a building in an MIDC area of Nagpur. They owned a building. They also owned a school management software, their own. They also owned an MRO, maintenance, repair and overhaul of complex assets like an aircraft. So they had 4 assets. Now, if I had taken this company to Infosys, what would Infosys have said? I like the OPD business, great, but I don't want this building. I build my own building. Yeah, so that's what I mean by coherency of assets. You want, whatever you're building, whatever you're owning, they need to have some coherency. Maybe this building wasn't a great example, but Infosys wasn't interested in the school management software. So what I did, eventually we did sell the company off. I still own equity in that company. We sold the school management software to NIIT. Yeah, we sold the OPD business to another company. I will not name them, they're a listed company. But it was talked about when when Pirmanath was introducing. Yeah, so we sold the company in different assets. So it's important to have coherency of assets. Clarity of next raise, exits or return. For me, I need to have the confidence, like I said, is this the right team? Are they in the right market to get me at least 1x return? Obviously, I want 10x in 1 year. Yeah. So, okay, there's one piece which is very, very important before I get to the cap table. Where the buy is better than build. Okay, build versus buy. Think from the point of view of the acquirer. Yeah, will the CFO of that company, of the company which is going to acquire your company, agree to giving the CEO the money to buy your company, or tell him, sir, why are you buying this company? I'll give you so much money from my budget and I'll give you 6 months, I'll build it for you. Yeah. So in the exit consideration, build versus buy is also something that I need to look at. Did you understand this one, sir? Did you understand this, sir? No, really. Okay. So let's say, this is a real example. An entrepreneur comes to me and says, look, I have built a fantastic business around managing coaches for sports. The business got started with booking of playgrounds where matches could be held. But the guy built an entire ecosystem around it to say he went to Bhaichang Bhutia Institute, he went to Ramanathan Krishnan in Chennai, he went to, which is that badminton, Pulela, Gopichand Pulela. So he tied up with those institutes and said, those guys who don't make it to the nationals, I will hire them as coaches. And then he had a booking engine to block the playgrounds, public playgrounds, private playgrounds. Yeah, great, everything great. I asked him about who's going to buy you. He says, well, Book My Show would like to buy me. Book My Show's run out of ideas. They like to buy me. So I said, let's examine the books of Book My Show. Let's see if they have this kind of money. You're taking 3 crores and giving me a pre-money of 27 crores, yeah, 10%. So 30 crores is the business. Now I want 10x. In 5 years, 10x. So let's say you're going to be worth 300 crores. I will get my 30 crores. So against the 3 crores, I'll get my 30 crores, assuming no further dilution in the company. Yeah. First of all, do they have the 300 crore money? Maybe they have. The CFO of Book My Show might turn around. This is a fake story. The CFO of Book My Show might turn around and say, sir, why are you paying 300 to acquire this company? I'll give you 30 crores. And in 9 months, I'll build this for you. Yeah, so build versus buy. That's the story. That's what I mean. So a lot of people come and say, sir, I'll get acquired for this price, that price. Well, is it true? Let me examine. So it's important for me to do this clarity on exits.
Sorry.
Yeah, ma'am.
In this context, isn't there value to an early strategic investor?
In what way?
For example, if someone, so you have a core technology.
Yeah.
There's a strategic investor who's able to either sell that technology for you or incorporate and sell it.
Yeah.
Right. They put early money in. The downside is that there are competitors and you're probably blocked from going to the competitors.
So
but the upside,
no. So that's why I said in 6 months I can build it. So I will rather build versus buy. But if it's going to take 6 years, then I would rather buy. Maybe 6 years is too much. If it's, let's say it's 2 years for somebody to, or even 1 year is a big time. Yeah.
1 year of those kind of.
Yeah, those kind of business. Absolutely right. Absolutely right. Spot on. Okay. Then I want to talk about clean cap table. Yes. 5 minutes? Yeah. Okay. Right. So how many of you do not understand what's a cap table? Please raise your hand. Yeah. So Cap table is a table in which the shareholders' names are listed, how many shares do they own, and what percentage equity do they own. So, typically when you start a company, two people get together, they put in 50,000 each, and they say, you know, it's a 10 rupee share. Yeah, so 50,000 divided by 10 rupee is 5,000 shares. 5,000 shares each, 50% each. Great going. The value of the company is 1 lakh because you put in 250,000. There's nothing in the company apart from that. Then the promoters go to their mama, kaka, chacha, uncle, auntie, friends, fools, everybody, and they say, you remember the time, mama, when I used to sit in your lap and play with you? Give me 30 lakhs. No, you're a rich man. The guy says, okay, I'll give you 30 lakhs, no problem, but I want 30% of your company. Yeah. So all these colored cells are where you put in the value. I have this Excel spreadsheet, I can share it with you anytime. Yeah. He puts in 30 lakhs, takes 30% of the company, 50% becomes 35%, right? Makes sense? You keep on raising money and keep on diluting. Yeah. Here at this stage, you've gone below 50%. Remember what I said? At an angel stage, you don't want to be below 50%. You definitely want to be 60 plus. Yeah. So unfortunately, this guy agreed to give 30% to his mama. But if he had managed to agree to give 5%, things would have been different. Unfortunately, I've run out of time to give you, show you the Excel spreadsheet which I have, but I'm quite happy to share that and meet up with you guys later on. So that's the importance of cap table. You must do this planning based on, okay, so this is different stages, how much money you raise and how much you getting diluted. Very simple mathematics, all 8 standard, 9 standard maths, like I said. Yeah, okay. But all this is arrived from what I call as the cash flow planning. Extremely important for you guys to do your cash flow planning. Yeah, I don't care about your P&L. You know, somebody will look at your P&L, but I am more interested in your cash planning. Receipts, not receivable. Yeah, money has hit the bank. So the top line is bank balance. How much money do I have in the bank? Assuming there's only one bank. Yeah. How much money has come in by way of investments, grants, debt, equity, whatever that might be. How am I planning my receipts, not receivables? The day the money is going to hit the bank. Yeah. So I do that planning. What is my operating expenditure? What is my capital expenditure? Yeah. So A plus B plus C minus D minus E is next month's opening balance. Simple. Now, if you assume 0 investments, yeah, then this bank balance will keep on reducing, correct? Until the receipts start to catch up. And someday you reach a peak negative. Yeah. So if I just raise this much money, put this value, turn it into positive and put it over here, this value will become 0 and every other number will be positive, right? So can I raise this money? Is that the requirement? What if something goes wrong? Right? What if something goes wrong? So I want to make sure that I have sufficient money to run at least 6 months without, even if things go wrong. Many businesses require 12 months of cash in their hand. Okay? So again, when we do one-on-one, we'll talk about what's right for your business, etc. But you want to raise the right amount of money. So in this particular case, what was the amount? It was some 1.5 crores was the peak negative, and 6 months of OPEX plus CAPEX, I can add to that. Let's say it's about 3 crores. Then I come back to this table where I talked about raising 3 crores. Yeah. And if I get 30% valuation for that, what will my analyst do? The analyst will say, okay, which other business at a similar level has gone and raised at this multiple? That's how the valuations are arrived at. So I have linked cash flow planning, amount of money raised, and attend in a comparable businesses, how have others raised money? That's the only way.
What if you don't have similar businesses to look at?
Okay, so there is, which is the oldest profession in the world? Don't talk about it. Business is business. Making money hasn't changed. Give me an example of a business which has not been created yet. I have exactly 2 more minutes.
So, I mean, we are building a brain-computer interface. So there are.
Okay, we'll talk about that in the specific example. Yeah. All right. So thank you for listening to my chat. Was it in any way useful?
Yes, it is.
Yeah. I just I link. So I gave you some general GAN, but it's all about cap table planning and cash flow planning. Okay, and knowing who you're going to raise the money from. Do they want you? Do you want them? Yeah, and it's a lot of homework. This is not technology. And by the way, to me, technology is commodity. I can put a bunch of, or the best way to kill your business is to hire your key people, poach them from you. I've killed your business. So technology is not the answer. Yeah, I mean, it is important. It's not the only thing. Thank you very much.